Gold's supercycle towards $10. The Fed's breath-holding trap and the sovereign debt bubble collapse. The global financial market is witnessing a brutal correction as gold prices are pressed down from their all-time highs toward the psychological support level of $4,000 per oz. This pullback unfolds against a backdrop of resurgent U.S. inflation, with CPI surging to 4.2%, and a stubbornly hawkish Federal Reserve. The central bank remains dead set against cutting interest rates, even leaving the door open for further hikes as non-farm payrolls doubled market consensus. However, from the perspective of long-term macro and technical analysts, the Fed's monetary tightening is by no means a sign of a resilient, sustainable economy. In reality, it is merely a short-term stopgap measure. Keeping interest rates at these restrictive levels is akin to a swimmer trying to hold their breath underwater. Once the limit of endurance is breached, the $40 trillion sovereign debt spring will snap back, triggering a massive supercycle that will propel gold to the historic $10,000 per oz mark between 2029 and 2030. 1. The Fed's underwater paradox and the $40 trillion sovereign debt ghost. Why is the U.S., buried under a mountain of debt, so intent on pegging interest rates at these sky-high levels? The answer lies in short-term survival. They must extinguish the inflationary fire first to defend the U.S. dollar's hegemony, even if this action quietly obliterates the underlying structure of public finance. The breath-holding metaphor. A person can hold their breath underwater for a minute or two to handle an emergency, but they cannot do it forever. The Fed is no different. They can tolerate skyrocketing interest servicing costs on public debt for a few months or a year to force inflation down. Yet, the longer they hold their breath, maintaining higher for longer rates, the more unbearable the underwater pressure, the mathematics of sovereign debt, becomes. Let us examine the mathematical reality of a debt pile fast approaching $40 trillion, with interest rates pinned around 3.5% to 3.75%. The U.S. government must shell out roughly $1.5 trillion to $2 trillion annually just to service its interest payments, a figure that now eclipses the national defense budget. To fund these interest payments, the U.S. Treasury has no alternative but to keep issuing new bonds, essentially rolling over old debt with new debt. As rates stay high, the debt pile snowballs exponentially. Eventually, the swimmer will run out of oxygen. The Fed cannot maintain or raise rates indefinitely. Doing so would suffocating the real economy, triggering corporate bankruptcies and widespread unemployment, and driving the government into fiscal insolvency. 2. The generational tipping point. Why the Fed is bound to return to 0%. Even though the U.S. enjoys the exorbitant privilege of printing its own currency, thus avoiding a technical default, it will be forced to hit the system's reset button once the real economy begins to fracture. When the interest payment burden hits a critical breaking point or the commercial banking system flashes signs of a domino effect collapse, the Fed will have to lower its weapons against inflation to save the nation's survival. It will do so via an emergency rate cut back to 0% and the deployment of an open-ended quantitative easing (QE) money printing program. 3. The roadmap to $10,000 gold in the 2029-2030 era. From a long-term technical perspective, the Fed's current price suppression is nothing more than a vicious shakeout, designed to establish a rock-solid, medium-term floor around $3,800 minus $4,000 per oz, or a potential wick down to the 61.8% Fibonacci retracement level near $3,500 to $3.700. For unleveraged investors, this represents the single greatest asset accumulation window of the decade before the exponential leg of the supercycle takes off. Marrying gold's historical 8 to 10-year time cycles with structural supercycle projection models from major institutional research houses like Yardeni Research, the path to $10,000 comes into sharp focus. 2026-2027, the coiling phase, gold will carve out its bottom, consolidating energy to form a major double bottom or cup and handle pattern on the macro charts. Once the Fed officially pivots, gold will validate a massive impulsive wave 5, targeting an initial range between $5,500 and $6,300. 2029-2030. The blow-off top. This is the moment when the $40 trillion debt spiral, which could easily top $50 trillion by then, spins completely out of institutional control. The de-dollarization trend led by the BRICS Plus bloc will reach its climax, triggering a massive flight out of U.S. Treasuries and into hard assets. Consequently, the logarithmic gold chart will mimic the historical 8 to 9-fold explosion seen during the 2001 to 2011 bull run, catapulting the precious metal to the historic milestone of $10,000 per oz. Conclusion: the current sticky inflation and the Fed's hawkish rhetoric are merely a smokescreen blinding highly leveraged, short-term speculators. For value investors and macro analysts, the Fed's breath-holding act only guarantees that the eventual snapback of the sovereign debt spring will be all the more violent. The current $4,000 level is not the end of gold's golden era. It is the perfect launchpad for the precious metal to pool its momentum, preparing for its historic journey toward the $10,000 milestone by the close of this decade.